Hello, Dr. Phil here. So this is a video on performance measurement and responsibility accounting. So let's jump right into it. So the first thing we're going to talk about is performance evaluation. Okay. So large companies, maybe medium-sized companies too, are easier to manage if divided into smaller units, are typically called things like divisions, right, segments, departments. In decentralized organizations, decisions are made by unit managers, and top management evaluates the performance of these unit managers. We also have three different types of centers. We have companies that are kind of broken down into cost centers. They're evaluated on their success in controlling actual versus budgeted costs. Profit centers are going to have revenues and costs. They're evaluated on their success in generating income. And then we have investment centers, which is basically a profit center, but they also deal with investments. And they're evaluated on the use of assets to generate income. All right, so controllable versus uncontrollable costs. So as they kind of self-explanatory, right? Controllable costs a manager can determine or influence. For example, supplies used in the manager's department would be an example of a controllable cost, compared to uncontrollable costs that are not within the manager's control or influence. So for example, the department manager's own salary, obviously they don't set their own salary. So responsibility accounting recognizes that control over costs and expenses belongs to several levels of management. So you kind of see the hierarchy of a company here, right? Working your way down, board of directors, president, right? EVP for Europe, EVP for US, EVP for Asia, right? Just if we look at the US one, the EVP has the plant managers for the Western and the Eastern factories reporting to him or her. And then again, you work your way down, right? There's a manager for the beverage department, for the food department, and for the service department. So you kind of got these hierarchies just working their way down. So responsibility accounting performance reports, this is just one example of how this could look. Every company will do this a little differently. So Executive Vice President USA, so for July, so we've got the salaries for the plant managers. Obviously, these are controllable costs for this person. Budgeted was 80, actual was 81.4, so they went over by 1,400, so on and so forth. And then if we look at the Western factory, right, 276.7 was budgeted. They were 2,800 over, 279.5. And then if we look at the plant manager for the Western factory, right, we can see, again, what can this person control? Well, the plant manager for the Western factory can control the salaries for the department managers. They were a little over there, 1,500 over. Building rent was good, right? Insurance, little higher than, a little lower than planned on insurance. They budgeted 68, was 63. And then if we look at the beverage department as one of this Western factory plant manager's lines, you can see here what can this person control, right? So we're just kind of working our way down the hierarchy of the organization and what can that person or individual control. So direct and indirect expenses. So direct expenses are costs traced to a department because they are incurred for that department's sole benefit, and they are easy to trace to that department specifically. Indirect expenses, not so much. So these are costs incurred for the joint benefit of multiple departments. They cannot be traced to only one department. Okay, so how do we allocate these indirect expenses? So indirect and service department expenses are allocated to departments that benefit from them. So the allocated cost equals the total cost to allocate, and we'll see an example of this in a second, times the percentage of allocation base used. So if we look at like supervisor salaries, again, we don't have to use these. These are just some examples of things, allocation bases that are common in industry. So like supervisor salaries, number of employees in departments, right? Rent and utilities, square feet of space occupied, makes sense. Advertising, percentage of total sales, and insurance, the value of insured assets, just as some examples. And then what about allocating service department expenses? So service department costs are shared by two or more departments. So service departments could include things like personnel, payroll, purchasing. That's obviously not an exhaustive list. There could be more. Those are just some examples. So again, what might be some common allocation bases for service departments? If we're looking at the office, then perhaps the number of employees or sales in the department. For personnel and payroll, number of employees in the department. For purchasing, the dollars of purchases or number of POs or purchase orders processed. And then for maintenance, square feet of space occupied. So as an example, let's take a look at an example of a cost allocation. So the retail store pays an outside company to clean. The total cost of cleaning service is $800 a month. Management allocates cost across the store's 3 departments based on square footage. So the 3 departments are here: jewelry, repair, and clothes, right? And then we've got the total square footage for the whole store is 4,000, and you can kind of see how this is broken down. 2,400 for jewelry, 600 for repair, 1,000 for clothes. And then all they're doing here is they're just turning those into percentages, right? So like 2,400, and I put the numbers here, into 4,000. 60% of the store is jewelry, 15% is repair, 25% is clothes. And then we're just taking that cost, right, at 800 bucks. It told us up here, total cost of cleaning service is $800 a month. And then we're just multiplying it by those aforementioned percentages to determine how much should be allocated to each department based on square footage. So let's now look at departmental income statements. So we think you've probably up to this point, you've always thought about like income statements for just a company as a whole, but we can certainly do individual income statements as well. So departmental income equals the department's sales minus any direct expenses of that department, minus any allocated indirect expenses, minus any allocated service department expenses. So we can see the service department here, the cost center. All right, because remember, the service department doesn't bring in any money. It just costs the company money. But I'm not saying it's not necessary. It is, but it just costs the company money, so it's called a cost center. And then we have operating departments that are profit centers, right? Profit centers, there's revenue and expenses. So for the service department, the cost center, we've got the department's direct expenses plus any allocated indirect expenses represents that total service department's expenses. For the operating departments, we're obviously going to have this. They're going to have sales, like we just said, minus any direct and indirect expenses for these, and then minus any allocated service department expenses. And then we'll arrive at our departmental net income. So think about, we have to allocate the service department costs to the profit centers because we can't just ignore that, right? We just got to find equitable ways to distribute them to the operating departments. So step number 1, accumulate sales and direct expenses by department and total indirect expenses, right? So you can see here we've got our expenses, we've got the service department purchasing, and then we've got our 2 operating departments, hiking and camping. So we've got our sales, obviously nothing for purchasing, because again, that's the cost center. Hiking, 136.2, camping, 90,800. We've got our cost of goods sold for the 2. And then we have salaries, and again, you can kind of see some of the salaries that we have here. Now, obviously, there are salaries for the purchasing department, right, as you would expect. And then we have the total expenses here. It looks a little weird because they've kind of put the total expenses on the left. So like the salaries of 41 would be the 15, the 14 and some change, and the almost 12 and some change would give you that 41. The depreciation, same thing. Just add them up kind of and just it's summed here on the left, 3,000. And then we have our indirect expenses for rent and advertising. We have total expenses of 208,000. So then step 2, allocate indirect expenses to all departments. So the rent of 12,000, if we go back, there it is, the right rent, 12,000. Don't forget advertising is 4. So rent of 12 is allocated to all departments based on square feet. So purchasing, 1,800 square feet, hiking 27, camping 45. Total is 9,000. And then they're just doing what we did before. They're just determining the percentages. So like 20% of the total store or total enterprise, if you will, is purchasing. So that's 20%, 1,800 divided by 9, and then so on and so forth. So all they're doing here is getting the percentages. And then they're saying, okay, 12,000 is total rent. So purchasing gets 2,400 based on 20% of the square footage. Hiking gets 3,600 based on 30% of the square footage. And then camping gets 6,000 based on 50% of the square footage. And then advertising of 4,000 is allocated only to operating departments based on sales. So again, the cost center, if you will, you don't need to advertise a cost center, right? You just need to advertise your operating centers. So it's split between hiking and camping. So here we have a ratio based on sales. So 60% of the sales is hiking, 40% is camping. So they did their 60-40 splits to basically allocate out the cost of the rent, or the advertising. All right, step 3, allocate service department expenses to operating departments. So purchasing expenses of 19,400 is allocated based on the number of purchase orders. So again, they're using number of purchase orders. Don't forget, you can really use whatever you want. You have kind of carte blanche to use whatever you want, as long as it makes sense and there is a sort of a, causal relationship, if you will. So hiking had 840 purchase orders, camping 360 for a total of 1,200. So again, they're just doing the percentages, 840 over 12, 360 over 12. 70% of POs, purchase orders, is hiking, 30% is camping, and then we took the 19.4, and we just times 70%, and then 19.4 times 30%. And then here we kind of see everything we just did. We sort of put everything together, and now we have our total expense allocations for the various departments, right? So we've got the purchasing department. Remember, this is the cost center. And then we've got our hiking and our camping departments. So it's the goal here is to try to, equitably allocate the expenses based on whatever the allocation base may be that you've come up with. Once we've done that, we can prepare our income statements. So we have hiking and camping. Obviously, there's no income statement if we go back for purchasing, because remember, purchasing is a cost center. So we have our hiking and camping, and then we've got our totals on the right. And then we've got all the amounts that we allocated. So we can see here that hiking is making 24,000. Camping appears to be losing 5,000. But remember, you got to be careful, because if you looked at that and said, well, let's just axe camping, let's just get rid of it, there may be fixed costs associated with camping that don't go away if you eliminate camping. So then hiking would then have to absorb that. All right, let's now talk a little bit about the departmental contribution to overhead. So the departmental contributions to overhead equals sales minus cost of goods sold and direct expenses. And the performance measure is based, of course, on controllable costs. So we can see here we've got our sales. We just saw this. If we go back, right, cost of goods sold, gross profit, etc. And then we have our salaries, depreciation expense, and then we have our total direct expenses, right? Our departmental contribution to overhead is as follows. So hiking has 43,580 to contribute to overhead, and camping has 84,20 also to contribute to overhead, for a combined amount of 52,000. All right, so what about investment centers? So an investment center managers, they're responsible for revenues and costs, like we said before, but also for the investment in operating assets. So like here we have two divisions, the LCD division and the phone division. We have our income, and then we have our average assets. So the first thing we'll look at here is what we call, I'm sure you've all heard the term ROI, return on investment, simply divided by income divided by average assets. So here we could say, okay, well, income 750 divided by 2.5 million. The ROI for LCD is 30%. Similarly for phone, income of 370 divided by 1.85 million. We have income of 20%. Next thing to talk about, this one's very simple, is residual income. So the residual income is the income minus the target income. Okay, so the target is probably set by their shareholders and their board is 8% of average assets. So the first thing we got to do is figure out, okay, well, what is the target income before we look at the actual income. So we know that the actual income was 750 and 370. Remember, they gave us that just in the prior slide. And then we can figure out the target income. So 2.5, if we go back, 2.5 was LCD, 1.85 was for the phones. So 2.5 times 8%, 200,000, 1.85 times 8%, 148. And then we're just basically getting the difference, right? So our target income was 200,000. We obviously blew that out of the water, 750, so 550 more. And then our target income for phone, 148. We did really well there too, 370, 222,000 more than our target income of 148. Okay, profit margin and investment turnover. So here we're looking at kind of really the amalgamation of two formulas, if you will. Profit margin is income over sales. Investment turnover is sales over average assets. And then we have we have our sales data, we have our income data, and then we have our average assets data. And then you can see where I did the calculation. Again, this is nothing difficult here, just a case of plugging in your numbers, right? Income, sales, and average assets. So you can see income 750, right? And then you can see the sales and the average assets. Okay, next thing is kind of switching gears a little here is what we call transfer pricing. So a transfer price is a price to record transfers of goods across divisions of the same company. So think about like Division A and Division B, both within the same company, kind of like Division A, say, for example, sells something to Division B. So they obviously have, maybe you could say, competing considerations. The LCD manager says, well, my department loses money if the transfer price is less than $30 per screen, so they don't want to let that happen. The phone manager is going to say, well, I won't pay more than the $80 market price to buy this from LCD, because why would I pay more than the market price? If I can get it cheaper from somebody else outside, I would do that. Right, so the range is basically a sort of a floor of 30 and a high or a ceiling of 80. Right, so we basically have the negotiation range of basically 50. Right, the difference between 30 and 80. So let's start. There's a couple of scenarios we should talk about here. One where there's no excess capacity, and then one where there is. So let's say that there's no excess capacity. And when we say excess capacity, we just mean that the company has no extra room to produce, like they're producing at their maximum capacity, if you will. So the LCD division is producing and selling 100,000 units to outside customers, so they have no excess capacity. The transfer price is therefore 80, right? Think about why. Because there's no reason for them to accept a lower amount, right? With no excess capacity, the LCD manager will not accept a transfer price less than 80 per screen. So this is what we call a market-based transfer price, because the LCD manager is basically saying, okay, well, there's no reason for me to accept less than what I can get in the market. Now, that's going to change if they have, as we'll see now, excess capacity. So what if the LCD division is producing and selling less than 100,000 units to outside customers? So now we have excess capacity. Now the transfer price is negotiable because, you know, the LCD division sort of has room to produce more, like excess capacity, right? They've got like an area of the factory where they're not doing anything with it. It's not generating them any money. So then they look at it and say, well, as long as we can cover our variable costs, then, you know, we would consider doing that. Okay, last thing to talk about, and then we will be done with this video, joint costs and their allocation. Just wanted to kind of touch base on this. So joint costs are costs incurred to produce or purchase two or more products at the same time. Consider a dairy company that incurs joint costs when it processes raw milk. So we've got the raw milk here. This is what we call the split off point, where you can basically take that raw milk and you can make different things with it. So they can make whole milk, they can make 2%, they can make 1%, or they can make skim. So the question is as follows: how should the joint costs be allocated to the different products, right? So if we're going to allocate them on a value basis, that's a very common way to do this. Then joint costs of a dairy company include, of course, as we just saw, right, include the whole milk, 2%, 1%, and skim. The joint cost of 30,000 will be allocated to the different products based on the sales value of each product at the split off point. So if you look down at the table here, we've got the type of milk, right? Whole, 2%, 1%, and skim, so 4 different types. We've got the sales value of the split off point, so like 12, 18, 16, and 4. And then we have the percentages of the total. And kind of to help you out, I put a couple of calculations down here for you. It's like the 12,000 divided by the 50,000, right? 12 divided by 50 is your 24%. So kind of like what we were doing before, you take in the sales values, like 12 over 50, 18 over 50, 16 over 50, and then 4 over 50 to get your percentages. And then we're saying, okay, well, then now we can go ahead and allocate these costs out. We know that we had an allocated cost of 30,000. So again, we can just apply our percentages to these to determine how much of each being like each of the 4 types, whole, 2%, 1% skim, how much of each should get what cost allocation. All right, that is it for this video, and I will talk to you all very soon.